Hi everyone and welcome to the Everyman Investor. So today we'll be going through how to find some treasure, specifically how to find a wonderful company at a fair price. So I have a few steps that I use to identify a wonderful company and also a few ways to find a wonderful price, a fair value price for this wonderful company. So the first step I usually go with is to find an investment thesis. This is very important. If the investment thesis does not work out, then it will be time to sell the shares of the company that you bought. So let's look at what are the investment theses that are hot at the moment. The first one is obviously artificial intelligence, which is the hottest thing in the markets. The second will be cloud computing, which is an expanding industry as well. And the third will be 5G connectivity. Many countries are now rolling out their 5G coverage, which will replace their 4G coverage. So as you can see, the areas where AI, 5G, and cloud computing overlap will be areas whereby you can find a lot of profit. If you can find a company that can profit from the expanding AI, 5G, and cloud computing markets, and they intersect each other or they overlap each other, it will be a good company to buy. But the bullseye is actually where all three companies overlap. Now, let's think about how all three companies can overlap. So 5G basically involves high-speed transfer of data. Cloud computing involves keeping data in the cloud so it can be accessed anywhere, and this will require 5G networks to be able to transfer the data out in a quick manner, because nowadays data transfer is actually very large in terms of the amount of data transferred. AI algorithms require data as well. They need data to be inputted so that they can come up with a new output based on the algorithm, basically called AI learning. So in general, all three of these expanding markets all depend on data. And this data is very important in the sense that it should not be corrupted. Data that is corrupted can cause many problems for the person who has got, say, for example, data in a cloud computing company or a company that keeps its data in the cloud. It can affect their identity, their credit card, bank accounts. So a lot of fraud can occur if someone can hack into the data. For an AI algorithm, if the data is corrupted and is inputted into the algorithm, you might come up with basically nonsense. For example, a lawyer actually tried to use AI to present or to prepare his case for presentation to a judge. And the judge found that it was all rubbish. And when he found that it was created by AI, he actually banned AI from his court from then on. So this data is critical, and the protection of the data is critical as well, which leads us to our investment thesis, which is basically securing that data. So we can see that cybersecurity is a potential gold mine where we can make many profits from. So step 2, we need to see whether or not cybersecurity is a growing industry. Our thesis states that it is basically the intersection of three different growing industries. So in theory, it should be a growing industry, but let's check whether or not this is true. So usually I go through Google as my first screen, and if you Google the cybersecurity's total addressable market, you see that the TAM, which is the total addressable market, has grown at a compound annual growth rate of 11.6% from 2017 to 2022. And you will see that the compound annual growth rate will be going up further to 12.3% from 2023 to 2030. In short, yes, the thesis works. This is a growing industry. So, step 3, we like to buy companies that are leaders in their industries for the simple reason these are the companies that stand to profit the most in an expanding industry. So again, we go to Google and we try and find what is the cybersecurity market share in 2023. So here we can see that the worldwide cybersecurity market grew 12.5% year on year from 2022 to 2023. And it outpaced the rest of the tech sector despite worsening macroeconomic conditions. So this is very, very good news for us. So even in a worsening macroeconomic condition, we can expect cybersecurity to grow. In fact, if you have been following cybersecurity closely, which I have because I'm invested in it, you will know that they did a survey of leadership among companies, and the leadership among companies stated that cybersecurity would be last on their list of budget cuts. So, in short, to them, securing data is the most critical thing for their business, and it will be the last thing they will cut from their budgets. So we can see there's this website called Canalys, which provided this data. So let's click on Canalys, and let's see what it has to say about the cybersecurity market and its leaders. So looking at it, we can see that basically the top three companies are Palo Alto Networks, Fortinet, and Cisco Systems. So Palo Alto basically grew its market share by 0.8% from 7.9 to 8.7% from 2022 to 2023, and its revenue growth was 23.6%, which is excellent. Fortinet also grew its market share from 6.2% to 7.0%. So basically, it's growing equally fast at 0.8% in terms of market share growth. And by its revenue growth is actually more. Its revenue growth was 26.2%, which is even better. Now, the third leading cybersecurity firm based on Canalys is Cisco. To be fair, Cisco is not a pure play cybersecurity firm. I will show you which are the pure play cybersecurity firms in a few further slide in this presentation. But we can see that Cisco actually lost market share, which is basically not a good thing. If an industry is expanding, the market leader should have an expanding market share rather than a declining market share. So this is a red flag, and we do not like to buy companies that are losing market share. Okay, so now that we know that what the industry is growing, we know that the leaders in the industry are growing their market share and growing their revenue, let's check whether their earnings are expected to grow. So I'll be introducing a few websites throughout this presentation. All of them are free. There is no money needed to use any of these websites. Okay, my first stop usually is simply Wall.Street. This is a very, very good website for screening a company that you are interested in. So if you scroll downwards from this homepage, you'll come to here. Which stock are you currently researching? You can click on that and you'll go to the homepage, enter in your stock name or ticker code. So we start with Palo Alto Networks. Okay, you can see a login sign up at the top right. You can actually sign up for a free account, 100% free, where they'll give you 5 companies with detailed information. As you can see, there's a company overview on the left-hand side. All these things will be filled in for you for 5 companies over a period of 30 days. So every 30 days, it refreshes your 5 companies. And my list is usually filled with companies that I'm either looking to buy or that I am interested in looking further into without having made up my mind whether to buy or not yet. So looking at Palo Alto, we can see that the rewards that is trading below its fair value. So simply Wall Street uses free cash flow as its fair value calculation, which to be honest, I do not understand yet. I personally use another metric, which I'll go through later. We can see that the earnings are forecast to grow by 24.7% per year, and it just became profitable this year, which is both a good and a bad sign. So we want to make sure that a company that became profitable manages to sustain this profitability. Now, there are certain risks that they have identified. Shareholders have been diluted in the past year. This is a potential problem. So assuming a company is making $1 million and they have got 1 million shares, their earnings per share is $1 per share. Now, if they issue more shares, usually to raise capital, so now they have 2 million shares, for example, and they're still earning $1 million, their earnings per share is only 50 cents, $0.5 per share. So it's basically halves its earnings per share, which is usually not a good sign. And then there is insider selling in the past 3 months. So this either means that the insiders think that the company's share stock is overvalued and that they're expecting the share price to drop, hence they are taking profits from what they hold, or there are various other potential insider selling patterns that are not so alarming. I'll go through this in another presentation when I look further in detail about insider trades. Now let's compare Palo Alto and Fortinet side by side based on the Simply Wall Street screener. So we can see that Fortinet is also undervalued at 37.4% below its estimated fair value. The earnings are slower than Palo Alto. They're forecast to grow 15.17% per year. but the earnings grew 57.2% over the past year, and Fortinet has actually been profitable for a while, and there are no risks detected from Fortinet from the checks. So taking a look at both companies, those who are perhaps more more tolerant of risk might pick Palo Alto. For me, I am not so tolerant of risk. I like low risk investments, so I will go with Fortinet. So this is just purely my personal investing style. Everybody has a different investing style. So as you have a good step-by-step screening method that can identify companies that you're comfortable investing with, it is perfectly fine to do whatever you think is best for your investing style. Okay, my next stop is always Barron's. So if you Google FTNT, which is ticker code for Fortinet, and you put Barron's, the search will produce the Barron's website with the Fortinet stock overview. So click on that and you'll come to a Barron's homepage. Again, it's totally free. You can actually sign up for a free account, which I've never bothered to. They give you a free newsletter every day, which gives you some commentary on the markets, but I've got tons of free newsletters already, so that's why I didn't bother to. Okay, if you notice on the bottom left, there is this analyst ratings and the average price target. Analysts basically will predict certain things about a company. They will predict where the stock price should be, what they think is the fair value in terms of the target price. They will predict what is the potential earnings growth or earnings decline. And analyst ratings can actually affect the movement of the stock. If an analyst, for example, upgrades the stock and raises its target price, chances are people will buy the stock and the price will go up. If an analyst downgrades it and lowers its target price, usually the stock price will drop. Now, this is where we can actually get profits, and I will cover that in a future video. Okay, what we are interested in is the full ratings here that I've underlined in red. Click on that and we'll come to this. So we can see that currently the analyst ratings are for Fortinet. Out of 36 analysts, means to say it's got very, very good analyst coverage. 24 of them, two-thirds of them think that is either a buy or overweight. So there are two different ratings sort of charts. So one goes by strong buy, hold, sell, and strong sell. Barron's uses overweight as buy and buy as strong buy, underweight as sell and sell as strong sell. So in general, nobody among the 36 analysts covering Fortinet thinks that you should be selling the stock. So they think you either should be holding the stock or you should be buying the stock. If you look at the stock target price, the lowest target price is $65, and at the current time when I'm making my presentation, the current price is $63. So based on the lowest, the most pessimistic analyst target, the stock is actually undervalued. But again, I have no idea how analysts come up with the numbers. They seem to pluck numbers from the air. For example, an analyst now thinks that Nvidia stock is worth $700. Given that most people think that AI is in a bubble, that seems rather insane to me, and I will never touch Nvidia stock at $700 now. So yes. Okay, then we look at the bottom left where we look at the yearly estimates of the earnings per share. Now we can see that it's growing nicely, and it's expected to continue growing nicely from 2022 all the way to 2025. The average earnings per share from the analysts shows that it will be growing 1.51 in 2023 to 1.74 in 2024 to 2.12 in 2025, which looks good as well. Okay, now we go into the financials of the company. So step 5, is the company's financial health good? Okay, so this is the income statement for Fortinet. We scroll down and what we are looking for is the interest expense. Okay, so basically I've introduced the concept of an interest coverage ratio in my previous presentation, and the current interest expense for Fortinet, okay, so it goes from 2018, 2019, 2020, 2021, and 2022. As you can see, in the earlier years, Fortinet had no interest expense, meaning to say they had no debt. Currently, in 2022, they had 18 million of interest expense. Then we look at their pre-tax income, which is basically how much they're earning. And we can see that they're growing their income at a fantastic rate. Now, there was a slight dip in 2021, which was probably related to COVID and the COVID crash. But even during that time, it was growing its pre-tax income at 16% a year. Now, that is a resilient company, which is a very, very good sign. Okay, next we go to the cash flow statement, which we are looking for a couple of things. So we scroll down again, and from here we look for the net operating cash flow. This is the amount of money that the company is generating from its operations. Again, we can see that it's growing very, very nicely. There's a drop from 38% in 2021 to 15.4% in 2022. This period coincides with the Fed raising interest rates. Again, the economy slowed. Again, it shows resilience for the company in a slowing economy, which is a good sign as well. So now we calculate what is the interest coverage ratio, and we can see that Fortinet is gold. So Fortinet's operating income is 1.73 billion over an 18 million interest expense, which means to say it practically pays almost 0% of its operating income in interest expense, meaning to say it's got tons of money to invest in the business, to do R&D, to buy back shares. And Fortinet has been very aggressively buying back shares, which is good, because unlike Palo Alto, which diluted its shareholdings, Fortinet actually, by buying back shares, it allows its EPS to grow. Basically, you remove shares from circulation in the market, and so it is the profit or the income per share actually goes up. So its earnings per share actually goes up. Okay, so step 6. So now that we know that cybersecurity is good, we know the market leaders, we have identified a market leader that we like. Now we know that the market leader has got good financials and good earnings potential. Now we need to find out what the company's business is about. So the easiest way to do that is to go to the investor page for Fortinet. Every company that's worth anything will have an investor relations page. You just have to Google investor relations of whatever company, and it should bring you to that. A company that does not have an investor relations page is probably a company you should not be investing in. In the investor relations page, you can actually find a lot of presentations, you can find their product solutions and support and services, so you can know more about the company. In the interest of time, I will skip all this. You can read it if you're interested in buying Fortinet shares. Suffice to say, I did buy Fortinet shares. So, let's go on to how to get that wonderful company, which looks like gold, at a fair price. Okay, there are a few metrics to determine what is the fair value of a company. The preferred one that I use is the price to earnings ratio. This only applies for companies that are profitable, which is Fortinet. It will not apply to Palo Alto, because Palo Alto does not have earnings consistently yet. Okay, so price to earnings is very simple. It's just the price of the share versus the earnings per share, or over the earnings per share. It is intuitively simple. Every company trades within a certain range of price to earnings. So basically, you know that if you buy, for example, below the median price to earnings ratio, just by chance, if you remember our maths in school, we will know that we will be up in terms of profits more than 50% of the time. Now, if we have identified a good company, we can hold, we should be able to earn a decent profit pretty well in the next 3 to 5 years, even if there's a market downturn and then the market goes back up again. Okay, for a company that's not profitable, we go to price to sales ratio instead. Now, price to sales ratio is tricky. The problem with price to sales is that it is very hard to gauge a median price to sales, because a company's price to sales, especially if it's not profitable, can vary very widely. So there is another way to see whether a company is undervalued, and I will go through that further along in this presentation. Then there's price to book, which is basically the price over the assets minus the net assets per share. To me, this makes no sense. It doesn't tell me whether a company is making more money. Assets can be things like, for example, their plants, their computers and stuff like that, which to me, I don't think it really reflects what I'm looking at in terms of earnings growth. And like I mentioned, SimplyWall.Street actually uses cash flow to value a company. This again is somewhat iffy to me in the sense that I still cannot understand how it works. To me, I can understand price to earnings and price to sales much more easily. Okay, so let's go to Fortinet median PE ratio. Remember I said that if you buy below the median price to earnings ratio, just by chance you'll be up in profit territory more than 50% of the time. So usually the website that I like to go to is YCharts. YCharts is totally free as well, except if you use it too often, you end up like me. There'll be a nice box that says here, register to continue using YCharts. Happily, the box does not block any critical information. As you can see on the bottom right corner, you can see what is the minimum PE ratio over the past 5 years, the maximum PE ratio, the average, which I do not like to use because it can potentially skew towards the right of the curve. I prefer the median, which basically is where 50% is literally at. So if you buy below the median, again, just by chance, you'll be up in profit territory more often than not. And if you did research your company properly, you should be in great profit territory. So as you can see, it actually dropped below the median PE ratio from August 2nd and it's dropped below that since now. The reason it dropped was because of its earnings call and its earnings report. I'll go through that in the next couple of presentations. There is too much information to cover in one video. Usually this process takes me, if a company is really pristine, few days to a week or so. If the company requires many looks at it, maybe weeks to maybe a couple of months, I might actually put the company on my watch list and then I will go back to it again, say in a couple of weeks time or a couple of months or months time, to look at it again and see whether I'm missing something. So I usually have three different sort of watch lists. One is my portfolio, which is the stocks that I earn. The second one is stocks that I have already identified as potential buys, but they are not at the fair value yet. So those stocks I monitor closely in terms of the price. If the share value drops below its fair value, and if I have spare cash on hand, I will usually initiate a position. My portfolio is equally weighted in terms of the value of the shares, more or less. Some slightly more, some slightly less, but most of them are about the same value. In general, I usually buy if I'm very convinced by a company's potential and its history of earnings growth as well as its value. I might buy a full position in it. If I think that the market is going to gyrate up and down, I might buy a half position and then leave the other half for whenever the market drops further, or if the market doesn't drop further, I might just go in so long as it's at fair value. And the third list that I have is companies that I have screened that look interesting, but that I am not convinced of yet. But if it's trading at a very good discount, I will probably take a look again and see whether or not I want to start a small position in it. So these are the usually three watch lists that I have, and I sort of organize them. You can use a free portfolio organizer in simplywall.street. It's totally free, which is why I love it. Paying money for stuff is not my idea of good investments. Okay, so as I mentioned, price to sales is actually good for companies that have no profits or no consistent profits yet. Usually price to sales is a good measure if you compare it to the peer average of the industry. So usually an industry, for example, we say AI. If you look at the price to sales for AI now, it will be very, very high. Nvidia's price to sales, I think it's in the high double figures, if not triple figures nowadays. And if you look, okay, so we're looking at the pure cybersecurity stocks, which are CrowdStrike, Zscaler, Palo Alto, Fortinet, and SentinelOne. As you can see, even for Fortinet, the price to sales shows that it is probably one of the most undervalued companies in that industry. For Palo Alto, it is actually below the peer average. So at 11 times price to sales, it means to say that it is currently priced for 11 times the year's sales. So it's priced for 11 times of 11 years sales. So we can see that the sales growth has been growing very nicely at 14.5% and 15.2% for Palo Alto and for Fortinet. Now the other three, if you go for example, as I underline here, the price to sales, you can click it and you can change it to price to earnings. You will get NA not available for CrowdStrike, Zscaler, and SentinelOne because all three are not profitable, so there's no price to earnings to top off. Now, Palo Alto, I have since initiated a full position because over the past 4 quarters, it has demonstrated it is capable of sustaining its profitability, and it has also grown its earnings each quarter. Usually they compare quarter of this year to quarter of the previous year because of something called seasonality. I don't understand that concept yet. So the thing is, different industries do well in different quarters of the year for some reason. The technicalities, honestly, I don't think it helps in investments, but we want to know that even with seasonality, the company is growing its earnings compared to its previous year's performance, which Palo Alto and Fortinet have been doing very consistently. The last thing I like to do before I buy a stock is to go through the ownership test. So basically, as I mentioned, an investor is in it for the medium to long term. Now, my thesis for cybersecurity is it's a growing industry. These companies are the best in the industry and they are growing earnings. So in both cases, for Fortinet and Palo Alto, my thesis is that they should be growing their earnings at more than 15% a year. If they start to show declining acceleration of their earnings growth, I would consider taking my profits and selling my position in both stocks. But at the moment, both of them are performing fantastically. So how I decided to buy both Fortinet and Palo Alto is simple. Now, Fortinet basically started off as a pure firewall company. It has got the best in class by a long shot firewall product. If you go and check the stats on Fortinet's firewall, it performs faster, it performs better, and it uses less energy than any other company's firewall. It caters to customers looking for efficient cybersecurity at lower price ranges. So basically, if you're a small company owner and you've got, say, 1 to 2 shops, you want to secure the data in your computers. You have not much in terms of data on the cloud, for example, because you don't have multinational branches all over the place. Fortinet reports its earnings. Its highest customers pay more than 1 million. Palo Alto, on the other hand, reports its earnings with its highest customers paying more than 10 million. And Fortinet is expanding its product range from its legacy firewall to, okay, so these are all basically terms in cybersecurity. You can Google all of them: SD-WAN, SaaS, and cloud, if I'm pronouncing it correctly. I had to Google all of them to find out what exactly they are when they were first reported by these companies. So the way I look at it is Fortinet basically is their best budget burger joint, and it is the best burger in that class by a long, long way. Now, Palo Alto, on the other hand, has got a best-in-class threat detection system. Its threat detection system is the fastest you can get, and it caters to customers needing customized, complex cybersecurity solutions. As I mentioned, it operates more in the high-end, high product cost area and charges more for its services. Palo Alto has a very unique modular system. So it's got various security options and security systems, and it basically discusses with its client what solutions are needed that the customer needs. And by mixing and matching those modular systems, each customer gets a unique product, which is why it charges a premium for its services. So to me, Palo Alto is like the gourmet burger joint. It is basically the high-end stuff. You go there, you want the best, you're willing to pay for the best. To me, by buying both Fortinet and Palo Alto, you basically corner the high-end market and the medium and low-end market. Both these companies are growing very well. Both these companies are the only profitable companies in the cybersecurity market, and both these companies have got their own unique best-in-class systems. That is the ownership test. You know your business and you know why you're buying your business, so that you know when to sell when the business stops performing as per what you think it should perform at. So thank you for watching this video. I hope the information I provided helps in your own investment journey as you try and identify a wonderful stock and as you try to find a fair value for that wonderful stock you have identified. As I mentioned, I will go through insider trading, various sort of chances to buy on the dip, and all during future videos. And I hope to see you soon in my next video. I hope this was useful for you, and thank you very much for watching.